If you listened to Wall Street last year, you missed it. Back in 2024 and 2025, most major banks and analysts said gold would probably top out around $2,500, maybe $3,000 if things got extreme. Goldman Sachs, JP Morgan, Bank of America, they all published reports with modest targets. Instead, gold did something almost no one expected. It surged more than 60%, and by early 2026, it crossed $4,000 an ounce. Not during a crisis, not during a panic, during what everyone kept calling a strong economy. And that's the part nobody really wants to talk about, because Wall Street wasn't just early, they were wrong. And if you're wondering how the so-called experts missed something this big, it's because they were watching you, when they should have been watching the whales. Have you ever looked at the market lately and thought, everything looks fine, so why does this feel wrong? Your retirement account is near all-time highs. AI stocks are everywhere. Nvidia, Microsoft, Meta, all hitting new records. Crypto is suddenly back in conversations. Bitcoin crossed $80,000. Every headline keeps saying the economy is strong. Unemployment is low, corporate earnings are solid, but at the same time, groceries still feel expensive, rent never really came back down, debt keeps growing, and somehow it feels like we're standing on thin ice. You're paying more for basics, your savings don't stretch as far, and every time someone says soft landing, you wonder if they're actually seeing what you're seeing. And if you've had that feeling recently, that quiet, uncomfortable sense that something's off, you're not paranoid. Because in a minute, I'm going to show you the one signal that explains exactly why your gut feeling is right and why Wall Street is quietly getting nervous. My name is Ronald, and I spend way too much time thinking about money, markets, and why things tend to break right after everyone feels comfortable. And if you're someone who's trying to invest responsibly, build long-term wealth, and avoid getting blindsided by things nobody warned you about, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we're talking about a signal that almost no one is watching, but historically, it shows up before major financial turning points. And that signal is gold. The contradiction. Here's what most people don't realize. Gold isn't supposed to rise when stocks are flying. It's not a growth asset. It doesn't pay dividends. It doesn't innovate. It just sits there. Historically, gold moves when trust starts to weaken, when people get scared, when confidence cracks, when the future feels uncertain. So when stocks, AI, and crypto are all rising at the same time, that's not confidence. That's confusion. Different parts of the market are telling completely different stories. Some assets are screaming risk on, others are whispering protect yourself. And markets hate confusion more than bad news, because confusion means nobody knows what's actually priced in. The data nobody's talking about. Here's where it gets really interesting. According to data from the World Gold Council, central banks bought over 1,000 metric tons of gold in a single year, the highest amount ever recorded. Think about that for a second. More than during the 2008 financial crisis, when Lehman Brothers collapsed and the global banking system nearly froze. More than during the dot-com crash, when trillions in market value evaporated. More than during the COVID panic, when entire economies shut down overnight. And here's the part that should really make you pause. They didn't buy during a crash. They bought while markets were near all-time highs, while everyone else was celebrating, while headlines talked about new bull markets, while retail investors piled into stocks. That combination almost never happens. When central banks, the people who actually control money, start quietly moving into gold while publicly saying everything's fine, that's not a random decision. The numbers behind the move. Now, before we go any further, let's get one thing precise, because this matters for credibility. Total global debt, public and private combined, has crossed $300 trillion. That includes government debt, corporate debt, household debt, student loans, mortgages, everything.
Government debt alone is lower, around 100 trillion. But when central banks assess risk, they look at the entire system, not just governments. Because debt at this scale limits future options. You can't easily raise rates without breaking something. Companies can't refinance. Homeowners get squeezed. You can't easily cut spending without political backlash. Every program has a constituency. Every cut creates opposition. And inflation becomes politically convenient because inflation quietly reduces the real value of debt. It's a hidden tax nobody votes on. And here's the key difference most investors miss. Retail investors chase returns. Central banks manage survival risk. Retail investors ask, how much can I make? Institutions ask, what happens if I'm wrong? Gold isn't about winning big, it's about not losing control. So why are central banks quietly buying gold? There are three main reasons, and they all point to the same conclusion. First, long-term inflation risk. Even if inflation cools in the short term, structurally it's higher than it was over the last decade. Think about the forces at play. Aging populations mean more retirees, fewer workers, and higher healthcare costs. Massive government spending that's politically impossible to reverse. Defense, social programs, infrastructure. Reshoring supply chains after decades of globalization. Moving production back home costs more. Geopolitical tensions that disrupt trade. Tariffs, sanctions, fragmentation. Those forces don't disappear just because inflation prints a lower number one month. They're baked into the system now. Second, currency trust. This is the subtle one most people miss. When too much money gets created, when debt piles up, and when future promises outnumber realistic solutions, trust doesn't collapse overnight. It erodes slowly, quietly, one decision at a time, one policy shift at a time, one compromise at a time. And once trust starts fading, it's very hard to restore. You can't just say, trust us again. You have to prove it, and proving it requires discipline that's politically painful. Third, system concentration risk. The global financial system has become heavily dependent on a small number of currencies, institutions, and policies. What happens if one of those breaks? What happens if trust in a major currency falters? What happens if a key institution fails? Gold has no counterparty risk. No one has to promise to pay you. No government has to stand behind it. It has no policy promise. It doesn't depend on interest rates or central bank decisions. It has no political dependency. It works the same regardless of who's in power. That's why institutions use it when the future gets blurry. The psychology of smart money. This is where it gets really interesting. Central banks aren't predicting a crash. They're acknowledging uncertainty, and uncertainty is the enemy of overconfidence. Here's the psychology most investors miss. Retail investors react to price. Gold hit 4,000. Should I buy? Is it too late? Institutions react to fragility. What's my downside if multiple things go wrong at once? By the time gold becomes obvious to the public, it's already too late to use it properly. That's why people say things like, gold didn't even go up that much during the last crash. Exactly. Insurance doesn't need to explode in value. It just needs to still work when everything else doesn't. The math that matters. Let's make this concrete with simple math. Say you have a $100,000 portfolio fully invested in stocks. If markets drop 30%, which is historically not that unusual during major corrections, that's a $30,000 hit. Your portfolio is now worth $70,000. You need a 43% gain just to break even. That could take years. Now imagine instead you had even a small allocation, say 10%, just $10,000 in defensive assets like gold. That allocation doesn't need to skyrocket. It just needs to not collapse at the same time as stocks. Let's say stocks drop 30%, but gold rises 20%. Your stock portion loses $27,000. Your gold portion gains $2,000. Your total portfolio drops to $75,000 instead of $70,000. That might not sound like much, but here's what really matters. That cushion reduces panic. You're not staring at a 30% loss. You're looking at a 25% loss. It reduces forced selling. You're less likely to dump everything at the bottom because you're not in pure survival mode. And it dramatically increases your ability to stay invested long enough to recover because you have breathing room. Most people don't fail financially because they're wrong. They fail because they panic at the worst possible moment.
What this means for you. So what does this actually mean for you? First, stop assuming high prices mean low risk. Markets can look calm while stress quietly builds underneath. Volatility can be low while fragility is high. Just because something hasn't broken yet doesn't mean it won't. Second, understand that diversification isn't just mathematical, it's psychological. It keeps you rational when volatility hits. It gives you the emotional bandwidth to make good decisions. When everything's correlated to stocks, you have nowhere to hide mentally. Every down day feels like the end. But when you have assets that move differently, you can think clearly. You can be strategic instead of reactive. And third, pay attention to what smart money does quietly, not what it says loudly. Press releases say one thing, quarterly filings show another. Public statements are optimistic. Private moves are defensive. Gold buying isn't a headline, it's a whisper. And whispers often tell you more than shouts. The bigger picture. This isn't a crash prediction, it's a signal interpretation. And history shows that the people who win long-term aren't the ones who panic early. They're the ones who prepare quietly while everyone else feels comfortable. They're the ones who ask uncomfortable questions when everyone else is celebrating. They're the ones who understand that risk doesn't announce itself, it accumulates silently. If this video helped you see the market differently, hit the like button. It really helps the channel. Subscribe if you want calm, rational explanations in a world full of financial noise. You don't need to be scared to be smart. You just need to understand the signals before everyone else notices them. I'll see you in the next one.